What if I told you the biggest financial mistake you will ever make isn't picking the wrong stock or ETF? It's doing nothing at all? In this video I'm going to break down exactly how I would invest today if I had to start from scratch, with no portfolio, no prior knowledge and only a desire to grow my wealth. Whether you are just starting or want to level up your investing strategy, what I'm about to share will save you years of mistakes and potentially make you thousands, if not millions of dollars in your lifetime. Hey, my name is Dominic and I've been investing for nearly 10 years. And in that time, I've made some good moves and a lot of painful mistakes. The kind of mistakes that cost me real money. But those mistakes taught me something far more valuable than any book ever could. And today, I'm going to tell you everything I wish I had known when I was starting out. Not generic advice, real strategies, specific funds, mistakes I made, and exactly what I would do if I had to start from zero. Because the truth is, most people misunderstand investing completely. Ask a few people around you what investing means, and you will probably hear things like buying stocks, trading crypto, putting money in a savings account, or they will imagine those chaotic scenes from Wall Street movies, guys yelling into phones, screens flashing red and green, but none of that is the core of investing. The real goal of investing is simple: to make your money work for you. It's about building a machine that over time generates more money without you constantly working for it. It's a tool for freedom, for time and for wealth. And the sooner you understand that, the sooner you will start making better financial decisions. Over the years, I've met dozens of people who are wealthy. Not flashy, not overnight millionaires, but truly wealthy. And almost every single one of them had two things in common. Number one, they invest in assets, primarily stocks, ETFs or real estate. And number two, they invest in themselves. They read, learn, take courses, and surround themselves with smart people. Those two things, compound interest and self-improvement, create unstoppable momentum over time. That's why if I were starting today in 2025, those would be the first two pillars I would build on. One of my biggest regrets, I waited 2 years to start investing. And what's wild is that it only took me 15 minutes to set up my first account. 15 minutes. That's shorter than an episode of your favorite Netflix show. We procrastinate not because it's hard, but because we are afraid of doing it wrong. But here's the truth. You can learn the basics of investing in 20 hours of focused effort. But most people wait 20 years to even start the first hour. And every year you wait, it costs you thousands, if not millions of dollars in missed compounding gains. Time is an investor's best friend. The earlier you start, the less you have to contribute. Compound growth does the heavy lifting for you. So if I were starting in 2025, I would set up my brokerage account today and automate that first investment, even if it's just $50 or $100 a month. Here's something I wish I had added to my strategy sooner. Smart beta. Smart beta might sound complicated, but it's just a way of adjusting your portfolio to favor factors that statistically outperform the market over time. The two most powerful ones: size factor. Smaller companies often outperform bigger ones, and value factor. Companies that are undervalued tend to give better returns long term. When you combine them, you are looking at a historically proven edge. Studies show that small cap value stocks can outperform the market by an average of 1.9% annually. Now that not might sound like much, but over 20 years, that's a huge difference. If I were starting today, I would include ETFs like ZPRV for US small cap value and ZPRX European small cap value, but these are for Europe. Yes, there's a bit more volatility, but there's also more long-term growth potential. If I had included these from the day one, I would probably have 5 to 10,000 more in my portfolio today just from that one change. Another mistake, I was too cautious. At 20, I treated investing like I was already 60. I stuck to dividend-paying giants like Coca-Cola, Johnson & Johnson and Procter & Gamble. Now, those are great companies, but they are not great for building wealth when you are young. I was investing as if I was preparing for retirement when I hadn't even started my career. If I were starting today, I would take more calculated risks. I would lean more into growth stocks and tech giants like Microsoft, Meta and Apple, companies that still dominate their industries and have strong long-term growth potential. Fear held me back, and that fear cost me returns. Here's something I've learned after a decade in the market. There is never a perfect time to invest. In 2015, when I started, people were already saying the market was overvalued. Back in 2004, same story. If I had waited for the perfect moment, I would have missed out on a 350% increase in the S&P 500. So instead of trying to time the market, what I do now and what I would do if I were starting is simple. Invest regularly, stay consistent, keep buying. Because the best time to invest was 20 years ago and the second best time today. One of the easiest way to destroy your returns is by paying high fees. If you are paying just 1% annual fee on your investments, you will lose nearly 28% of your total returns over a lifetime. At 2%, you are giving away half of your profits. That's right, half. And most actively managed funds charge closer to 2% than 1%. So if I were starting today, I would avoid high fee funds like the plague. I would focus on low cost index funds and ETFs and learn how to manage my portfolio myself. Because once you learn how to invest, you realize you don't need a fancy suit or a Wall Street firm to grow your money. You just need a plan and consistency. Another early mistake I made, I had no strategy. Within 2 years, I owned over 25 different stocks, just random picks, chasing hype, hoping something would stick. That's not investing, that's gambling. If I were starting over, I would create a simple asset allocation strategy right away. For beginners, maybe 80% index funds and ETFs, 10% small cap value and 10% high growth stocks or emerging markets. That's it. No guesswork, no stress, just a strategy to stick to. Because the moment you build a strategy, you take your emotions out of the equation, and that's when you start making money consistently. And finally, understand this. Investing is not saving. Savings accounts are safe, but they don't grow your wealth. On the other hand, investing comes with risk. Markets crash, stocks drop, it happens. During COVID, stocks fell 35% in a matter of weeks, and look what's happening now. These crashes happen every 5 to 10 years, but risks isn't the problem. Not knowing what you are doing is the real risk. The more you learn, the more you can manage that risk. That's why I always say, the best investment you can make is in yourself. Let me leave you with this. Life is a bit like Monopoly. If you don't buy assets, if you don't take calculated risks, you will keep passing go, collecting your paycheck and watching others build wealth. You don't win Monopoly by saving money. You win by making smart moves early and building a strategy that pays off over time. Start building your strategy today, because your future self will thank you.